What's going on, everybody? Welcome back to my channel. In today's video, I am going to show you guys my main strategy that I use for a lot of my trading. And a lot of my Patreon members have been asking for a step-by-step guide for this particular strategy. And I'm like, you know what? I'm going to share it with all of you guys as well, because sharing is caring. And I want all of you guys to do well, okay? So this is the strategy, and today's video is completely unscripted. I wanted to just make a step-by-step guide. So just watch till the end, like, hit, subscribe, do all of that stuff if you guys like. But I wanted to make just a tutorial of how amazing this particular options trading strategy is. And I've been using it, and this is my bread and butter play. I do this all the time, and I'll show you guys some results too. So it's called the double calendar spread. Not very popular because it's boring as hell. A lot of people want trading to be super exciting and all of that stuff. This is a boring strategy. You let time work for you. You collect money, but it's super profitable. Like, these are some of the open positions that I have right now on this double calendar spread, as you can see. And this one's still cooking. These ones are doing pretty well. So over the last 76 trades that I've done with a double calendar spreads are very popular. I started making adjustments to it and calling it a double calendar spread. And over the last 76 closed trades, this thing has a win rate of 77%, 59 wins, 17 losses, 77% win rate. Average profit is 22%, average loss is 11%, and average days held is 18 days. With this, so it's 1 to 2 risk to reward with a 77% win rate. That's freaking ridiculous, okay? Especially when you look at the sample size of the data, 76 trades. All of these trades, if you guys, these are all documented. If you want to see the actual proof of every single one of these trades, when I got in, when I got out, that's all in my Patreon. Link is in the description below. Even as a free member, you can look at all of these particular trades and you'll be able to see that this is what happened. So just to show you, today is January 31st, 2025. It's the end of the month. So year to date, so this month, this is how much I've made using the double calendar spread and a little bit of the 0 DTE spike iron condors that I do. That's what I use this Robinhood account for. A lot of my other trades I do in my Schwab account, in my Robinhood, because the fees per contract aren't much, right? There's zero. You just pay a regulatory fee. I do all my double calendar spreads on Robinhood to save on fees, because if I did them in Schwab, man, it is expensive, okay? Like, for this is 100 contracts on this Google trade. This is 100 contracts. So with a double calendar spread, each trade that I make, that's 100 contracts, is actually 400 contracts to get in, 400 contracts to get out. That's 800 contracts. So at 65 cents per contract, that stuff adds up. I don't pay those fees with Robinhood. So that's why I do these in Robinhood. So get ready, take some notes. Enough with the intro and all of that stuff about the strategy. Let me show you guys step by step what my process is, where I select how I'm going to pick a particular stock for the double calendar spread, and how I do my strike prices, how I actually enter a trade, because I'm about to enter a trade for one opportunities that I saw. So that's why I wanted to make this video, so you guys can see step by step exactly how I even execute the trade. If you guys are excited about this, drop me a boom in the comments below. So the first thing that I do is I log into my Market Chameleon account, and this gives me a bunch of ideas, because on the market alerts, it'll tell me, hey, these calendar put spreads, they've got some upside, stuff like that, right? So when I was looking through, this one seemed very good to me, because I wanted to get into another trade on Microsoft, because Microsoft just had earnings a couple of days ago. And I wanted to see, now that the earnings are done, things should be relatively stable. Let's try something on Microsoft. So first, what I do is, once I go into Market Chameleon, I kind of scan this. And if you guys want to check out Market Chameleon, I've got a link to it in the description below as well. Click View Strategy in the option chain, run analysis, and here we go. Okay, so this is pretty cool, where the price is right here. But I'm going to turn this into a double calendar, and I'll show you guys exactly how I look at it visually. I go into option strat, build calendar spread. I think this was a put calendar spread, right? Yep, put. So you're going to sell the March 21st and buy the April 17th, 395. So once I do put calendar spread, let's look at the dates again. I'm going to buy April 17th, sell March 21st, buy, I'm going to change the dates first. April 17th, I think this is already March 21st, right? April 17th, March 21st, and 395. There we go. Switch that over. And yep, the graph looks pretty similar to what it showed in Market Chameleon. So now I want to turn this into a double calendar. So what I want to do is, because Well, right now Microsoft's trading at about 416. So roughly about 20 points down. If it goes up, yeah, you take a loss, right? You take a loss on this. But the max profit is huge as well because the loss will be 227, max profit will be 706 if by the expiration of the short date, Microsoft is hovering around that 395 area. I want to also protect my upside because in trading, what we can do is we can manage our risk. No one can predict if the market's going up or down. The only thing that we can control is our risk management. So with this, I want some protection to the upside too. So I'm going to turn this into a double calendar. So now what I'm going to do is add, buy call. And since this was 20 points down, I'm going to go 20 points up. Okay, so that would be roughly 435. And we're going to change the expiration date to the same expiration date because both the buys need to expire on the same expiration and both the sells need to expire on the same expiration. Change expiration, April 17th. We did a call and now I'm going to sell a call. Okay, I'm going to sell a call, same expiration, 321, right, as 321, same strike as the one that's longer. So what makes a double calendar spread beautiful, and this is one of the basics, right, is the strikes need to be the same, the expirations are different. So how does this make money? Because on the short side, the options that you're selling, those will expire a lot quicker. The theta will kick in more and they'll deteriorate a lot quicker than the ones that you're buying. So that offsets and that's where the profit comes in. So now I have this set up. Here's what the table looks like, but I want more. Let me look at the charts real quick. So when I look at Microsoft's daily chart in my LuxAlgo Premium indicator, and again, if you guys want to check out LuxAlgo, I've been using it for years. I love it. I've got a link to it in the description below so you guys can check it out risk-free as well. All right, so Lux on a daily chart is showing a 3 down, a sell signal. So it's expecting it to go down. Candles are red and the money flow is increasing to the negative side. So there's more money going out of the stock than coming in right now. So I want to make more money on this towards the downside than the upside, but I want my upside to be protected. So let's look at the graph. Let's try 430, okay? Because if I do 430, that's right around here. In case if it starts going up, on the downside, I'm at 395, which takes me all the way down here through both of these supports. I like that much, much better. And now the net debit would be about 600 per contract and the max profit would be 554. Now here's the deal. With double calendar spreads, I do not wait until max profit. The reason I've been profitable is I usually do a take profit of between 20 to 30% and I do a stop loss at 30%. Now you're going to be like, why risk to reward 1-to-1? As you can see from the statistics, on average when I'm taking a loss, I'm only taking a loss of 11% on average. Sometimes it's a lot less, sometimes it's that full 30%. But on average, over the last 76 trades, it's been 11% is my actual loss. And my take profit is right around 22%. And now you're going to be like, okay, well, some of these trades are well over. Why have you not taken profits yet? Because again, when I did my analysis on some of this stuff, I'm going to probably close some of these trades out on Monday because I want the time decay for the weekend to help me make a little bit more money. For instance, here's a Google trade, right? If I look at simulate my returns, if Google stays flat at the same price right now, but I close it on February 3rd, which is Monday, right? At say 10 a.m., I make a lot more than what I'm currently making on it right now. What if it goes up? All right, let's simulate that. If it goes up, I'm still good, a lot more than what I'm making right now. And if it goes down, say 10, 15 points by then, I'm still making more than what I'm making right now. And that is the beauty of the double calendar spread is because that time decay helps. And that's how the profits add up. And this is one of the mistakes that I see a lot of traders making that I want to make sure that I point out is beginner traders will end up taking their profits too quickly and let their losses run a lot. So a 10% loss can turn into a 30% loss because they're hoping it'll turn around. And if a trade is up 30%, but if I can make 50, 60%, I'm going to let it run. Usually people that are starting, right, beginner traders will end up taking profits too quickly because they don't want to give back the gains. So, and that's where you have to manage your risk. So don't risk more than you can afford to lose. None of this stuff is financial advice, by the way, right? Nothing in this video is financial advice, but that's just how I do it. I've been trading for over 13 years and I'm a profitable trader. So this is what I've learned over the years that I wanted to share with you guys. Now, if I'm good with it going up to 430. Let's get back to this. and going down to 395. And as long as it's around that area, this trade should be profitable. This is what it's looking like. Let's make this a little bit wider. So the table looks like this. As time goes on, hopefully this trade's going to make some profit as long as the implied volatility stays the same or if the implied volatility goes up. This is where it can get a little tricky, is the results of this trade also depend on the implied volatility of that particular stock. And I'll show you how that fluctuates, okay? So if implied volatility goes down, you see how it starts becoming a loss. And later on, it's still profitable, but you'll see this fluctuation. If implied volatility goes up, the profit can be realized a lot quicker and you make more money. Again, with the graph, this is what it would look like with implied volatility going down, implied volatility going up. Right now, let's keep it at 0 because that's where we're getting into the trade and I'm happy with this picture. Let's do this. Let's actually get into the trade so you can see step by step exactly what I'm clicking, what I'm doing to get into this particular trade. So Microsoft, let's go into MSFT. I'm going to click on trade MSFT options. So buy the calls, right? Let's do the buy the calls first. So I'm buying a call for 430 expiring 417. So let's go to 417 expiration, 417, buy 430 right here. And I'm going to do buy a put 417 expiration, 395, 417 expiration. I'm on buy put 395. Now I'm going to go to the sell side of it, 395 put. I'm going to sell at the March 21st expiration. Now I'm going to go to March 21st expiration, sell 395. And this already shows me that this has a 78% chance of expiring out of the money. So there's only a 22% chance it's going to go below 395, hopefully, if things stay stable, right? Next, I'm going to do call, sell, the 430 call, same expiration as the other one that I sold. So 430, sell. So my total cost right now, this is what it's looking like. So I bought, so let's break this down. Let me move the camera a little bit so I can see what I'm reading. All right. So I bought a call for April 17th and I bought a put for April 17th, these strikes. And then I sold a put, same strike, sold a call, same strike, but the buys and the call, buys and sells are different expirations. Click continue. So the cost for each contract is roughly about $583. And you see the max profit, max loss, depending on where it goes. And this is even telling you that, hey, by expiration, if the price is here, this is how much you can make, potentially. I usually do these trades for about $10,000 a trade. Okay, so I'm going to do 20 contracts. Let's do 18 contracts. Yep, or a little over $10,000. And now since I'm buying, it's giving me a low fill. So let's try $6. It's still a low fill. I'm still going to give it a shot at $6. Okay, let's see if it executes. All right, great. Looks like it's starting to fill. Filled. Perfect. So now I'm in the trade. Easy peasy, right? So this is my bread and butter strategy that I've been using for quite some time that I really, really, really love. You guys saw the step-by-step process of how I go through selecting and executing a double calendar spread. So if you guys want to check out the trades that I'm actually making, check out the link in the description below to join my Patreon. And for instance, let me show you guys exactly what my trade alerts look like whenever I'm getting in and out of these trades. Okay, so the last double calendar spread that I closed was on AMD. So this is when I had got into the trade. I had my whole analysis with the graphs and all of that stuff, the strikes that I selected, what my stop loss was going to be, what my average cost was. Then when I exited, that's how that trade worked out. It made me a good $2,000 in just about, January 23rd is when I got in and I got out of it 2 days ago, January 29th. So this was a quick trade over a few days. Make sure you hit that subscribe button, like it, drop me a boom in the comments, and I will see you on the next one.